Well, I think when investors read about inflation, it needs to be specified a little bit better so that they can then see how it's going to impact what they buy or what they invest in. So a little bit of inflation can be positive for a lot of risk assets that most people have their savings invested in. Too much inflation is a negative for almost all asset classes. What actually are we expecting when we say that inflation is going to rise? Well, there's a range of things. And I think let's start with the prices of certain goods and services that we may want to consume. And we may see that the prices of those goods and services are rising very rapidly. That may then lead us to become a little bit concerned about inflation. If we then read articles and see headlines that warn us that inflation is set to accelerate, then we're going to look at all our savings and wonder how they will be impacted. So let's take a step back. We're in the middle of pretty much a V-shaped economic recovery. In other words, an extremely rapid recovery following a very dramatic shutdown and drop in domestic demand. Any recovery that takes this shape is going to generate bottlenecks, but not in every single sector. It's only going to create bottlenecks in the sectors in which there are pent-up demand and in which there hasn't been a sufficient supply-side response. So those bottlenecks are going to generate higher inflation in certain things. So, for example, it might be in semiconductors and the manufactured goods that require those inputs. It might be in the prices of certain services that we have some pent-up demand for. It could be haircuts, it could be the services of restaurants. But then there are other goods and services that are experiencing either falling prices or very subdued inflation. They might be, for example, the rental market. So inflation becomes a concern when it starts to rise too rapidly in aggregate. Because the economic recovery that's taking place is looking quite vigorous and quite healthy, we want to then look ahead and expect, it's quite reasonable to expect that we will experience an uninterrupted economic recovery, and as we do, inflation will start to rise to its target levels, to the levels that central banks around the world consider normal, consider consistent with stable inflation. So that is not so much a risk, but that's a prediction of a return to normalcy. And that is good for investors. It's good for risk assets. It's by and large good for most of the investable universe. It's not something, therefore, that we should be too worried about or looking to protect against with too much zeal. So while inflation, if we experience an uninterrupted economic recovery, might start to reach target levels in around 5 years' time, some observers are concerned that inflation will run away, will become too high. So that therefore means that the concern is that inflation will exceed the normal bounds by a significant margin. Should we be worried about that, and why? I think one of the reasons that has been cited for concern is that central banks have somewhat changed their policy framework. So since the 1990s, central banks adopted a policy framework aimed to deal with the problem back then of high inflation. So the central bank framework that was adopted in those years was one that was asymmetric. It was one that focused on upside inflation risks rather than downside inflation risks. What central banks have been dealing with over the last decade is downside inflation risks. So it makes complete sense for central banks to take this opportunity to reframe the policy framework so that it is more symmetrical and now also focuses on the downside risks to inflation. This is not a reason to be concerned that inflation will run away from us. Central banks still have plenty of ammunition and the correct framework to deal with upside inflation pressures if they were to eventuate down the track. And now they also have better frameworks to deal with downside inflation risks. But there's another reason we shouldn't be too concerned about runaway inflation. And the reason is, if we think about the low interest rate environment, cash rates around the world are at their effective lower bound, including here in Australia. And how long can that persist before the pressure valve needs to be released in the form of inflation? Well, it already has been released. Inflation has appeared for the past 10 years, but it has not appeared in the goods and services that we consume. It's appeared in the investable universe, and that universe includes houses, equities, bonds, artworks, vintage wines, you name it. This is the pressure valve that is released from low interest rates. This is where we are seeing inflation already. I think a good measure of inflation is underlying inflation measures. So underlying inflation is a concept and core inflation measures try to capture it. So the point of underlying inflation is to capture the trend because overall inflation is impacted by the vagaries of the weather and how they might impact banana prices, and we want to look through that, and central banks want to look through that as well. So it's measures like trimmed mean inflation in Australia that we would look at to gauge where inflation is at the moment and what the underlying trend is, and that will give us a little bit of a forward-looking indicator. Wage growth, as I mentioned, is also a good forward-looking indicator of inflation. Runaway inflation will start to be evident in very rapid increases in sequential inflation, so quarter-on-quarter increases. If they start to increase too fast for too long, then that would sort of signal that something is occurring, maybe something unexpected. Maybe pressures are building across the board. So that's one of the ways that we would look at inflation. I think if you were looking for signs of inflation rising a little bit too far, a little bit too fast, one of the signs would come from the labour market, from wage growth. So if wage growth starts to accelerate, that would be a pretty good leading indicator that overall price pressures are going to start to heat up down the track. That would probably be my number one signpost. I think if the RBA was to meet their target and growth would be uninterrupted for the next, say, 5 years, wage growth was to achieve, say, 3% or a little bit higher, productivity growth would, improve. If everything would happen along the RBA's, targets and plans, then that would be a positive for the overall economy. It would also be a positive for corporate revenue, which would help drive equity markets higher. So that type of inflation should be welcome inflation. It's inflation rising to normal levels from levels that today are too low. So this is not something that we really need to hedge against. This is something that a healthy allocation to equities should benefit from. What we need to be concerned about, if we do need to be concerned about inflation, is if inflation rises beyond what's considered normal and starts to sort of run away. That's when it becomes an economic cost rather than an economic benefit. And that is a risk that doesn't seem to be on the cards at the moment. There are no signposts that suggest that's a risk. There's no reason in terms of the policy framework in place for why that would be a risk. As I mentioned before, the policy framework has changed, but it is reasonable given that the problems we've been facing have been low inflation or high inflation. And also, while we are talking about risks that are difficult to predict and uncertain, we should consider other risks as well. And there are financial stability risks that low interest rates for a long time do contribute to. And at the end of the day, if a crisis occurs because of financial stability concerns, because of financial instability, and this is not something that we're predicting, but it is a risk just like any other, then what would be the safe haven that would protect investors from this type of risk? And really, there has not really been a substitute to the safe haven that government bonds provide in portfolios. There is an argument for shifting strategic asset allocations, but at the end of the day, government bonds still take an important place, hold an important place in portfolios. And while financial stability concerns rank as a risk over the next 5 to 10 years, government bonds will provide some protection. I think it'll be a long time before yields are a lot higher. So insofar as it's the level of yields that draws investors back into bonds, then I think that there's a long time that we have to wait before that happens. I think interest rates are going to remain low for a long time, but that's not a reason to exclude all fixed income, because it's a very large universe and there are a range of different sub-asset classes within the fixed income universe that can provide different levels of income, better yields. But also when we do look at different sub-asset classes in the fixed income universe, we have to be mindful that we are looking across the risk spectrum. And so we have to approach it in a very diversified manner.